Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stocks have rallied to fresh record highs. The driving force behind the gains, at least in the past few days, has been the tech sector. But that could change tonight. Investors are going to be watching results from Mag 7 stocks, including Tesla, Meta, and Microsoft. Wall Street will be watching to see if the massive spend on AI is starting to pay off a little bit more. Plus, it's Fed decision day. The central bank will issue its latest rate announcement, widely expected to keep interest rates on pause and direct attention back to the economy. But Fed watchers will be asking questions on the path forward, the DOJ's criminal investigation into Powell, and the future of Fed leadership. And Amazon is cutting 16,000 jobs. The e-commerce giant announced the layoffs as it works to, quote, reduce layers and remove bureaucracy. The reductions take Amazon's announced job cuts to 30,000 in 3 months after an initial wave in October. CEO Andy Jassy has been working to cut jobs following a hiring spree during the pandemic. He also said AI will shrink the workforce as Amazon automates more of its operations. Let's get a check-in on stock futures, where we have a mixed picture in terms of the indications for the open this morning. Dow futures indicating a very small drop here. S&P futures, though, indicating about 0.5% increase. NASDAQ 100 futures pointing to gains of 0.8%, showing some continued strength in large cap technology ahead of some of those earnings we mentioned. Meanwhile, it is earnings season, so you got a lot of individual moves that are larger than the index level moves. So we'll continue to talk about that and track that. As I mentioned, those big tech names set to report after the close today after helping to power the market to new highs Tuesday. Joining me now, Binky Chadha, Deutsche Bank Chief Global Strategist. Binky, it's always great to see you. It has been a really interesting 2026 already for a whole host of different reasons, but among other things, just sticking to the sort of market level, what's been interesting is this year thus far, what has been gaining the most has not been technology, right? But over the past week or so, we saw communications, services, we saw infotech come back to the fore and power that latest leg up. What happens when they start reporting earnings? Will that stop the rotation we've been seeing? People go back into tech, or what do you think is going to happen?
Yeah, I don't think it's a zero-sum issue here. I think one of the things that's been going on is if you take a look at equity positioning, fundamentals-based investors, of course, for the last 6, 8, 10 months have basically been hugging neutral. Over the last, I'd say month, a little bit more than a month, we've been getting sort of these policy shocks at the industry level, whether it's caps on credit card interest rates or it's institutional investors out of the housing market. And the list goes on, the Medicare reimbursement rates. And so what you're also seeing basically is positioning, start to move neutral basically at the sector level. And so if you take a look, for example, at positioning in tech and you compare that with positioning basically in the cyclicals, what you see is basically from both sides, you're getting a compression back to neutral. And so the reason I tell you this long story is that you fast forward to earnings season and the setup for mega cap growth in tech is suddenly, pretty good because positioning has been pared back quite a lot. So we're neutral basically on mega cap growth in tech because, there is an expectation over the next couple of quarters that growth will start to slow. But the setup right now is very positive. So if the earnings deliver, looking for positive reactions today.
Okay, and you are one of the more bullish strategists out there for this year, right? You're targeted 8,000. And so if it's not necessarily, if you're sort of seeing the sector positioning go back to neutral, where then does that remaining, we're at 7,000 now, but where does that remaining upside come from?
It's the market as a whole. Like I said, it's not zero sum. We have neutrals, we have overweights and underweights. So it's the market as a whole. And tech, of course, is a very big part of that. And I'm neutral, but, I am constructive basically on the market. And so It's about a relative performance. I mean, we've been long the financials for a while. We are still long. We are long the industrials on the view that we are getting basically a broadening out of growth, especially earnings growth. Started with third quarter earnings, and we're looking for that to basically continue in Q4 earnings. And so far, that seems to be tracking. It's, not blowing the barn doors off, but it is looking reasonable. Yeah.
And I'm curious about something that feeds back into earnings that's been in the headlines lately, and that is job cuts, right? We had UPS saying it was cutting 30,000 folks, Amazon cutting 16,000 for a total of 30 just since October. How, as a sort of macro strategist, do you think about this, right? Because on the one hand, you could argue this is good for the bottom line of these companies, but on the other hand, what does it say about the U.S. economy and the job market? So how do you parse that?
Yeah, so what I would say, the first thing to note is really that if you look at the labor market, which has, unambiguously basically slowed, and you think about it as hiring and firing, what I would say is the issue's not really on the firing side. A layoff and discharge rates have basically risen from post-pandemic labor hoarding lows, and they actually still remain below the range in which the layoff and discharge rate was pre-pandemic. What I would argue the issue is really on the hiring side. If you look at the hiring rate, we are basically at the lows of the pandemic, which is pretty remarkable by itself. And we're actually not very far above the lows that we saw in the hiring rate during the global financial crisis. Why is this the case? I would argue, you need to look at it basically in the context of the last 2-3 years, basically. So if you rewind the tape back to 2023, the hiring rates coming off from some pandemic highs. And then you have basically, the macro consensus, corporates, everybody's basically just waiting in 2023 for a recession. And so the hiring rate continues to dip down. I would say that continued basically through the early part of 2024. And then you have basically waiting for the election. So we're coming out of 2 years basically where, the wait and see mode has basically meant the hiring rate kept coming down. Starting in the middle of 2024, we start to go basically sideways. And then, of course, we have Liberation Day, it takes it back down. And so, I would say the simplest explanation of the very low hiring rate is simply, companies having been in wait and see mode. So things need to settle down. They need to feel a bit more comfortable about the outlook. And of course, expectations for the midterm elections are going to play a role here. But I would say the labor market's in a delicate way. It's not about the firing, it's about the hiring. And our baseline view is that hiring will pick up gradually as earnings deliver. I mean,
Binky, earnings have been kind of delivering, but that other thing you're talking about, the uncertainty, that doesn't feel like it's going anywhere, like in the foreseeable future, even after the midterms. I mean, I don't know about you. It doesn't feel like that's happening.
Yeah, I think, one of the things that's basically instructive is to think about how corporates reacted basically to the Liberation Day shock. And I would argue partly because they had been waiting for the prior 2 years, their response to the shock was, we can't wait any longer. We just have to accept that we live in a shock-prone world and get on with it. So we will see how recent events impact basically that dynamic and reaction. I think it's basically too early to tell, but I would argue, from an economic point of view, Liberation Day was a really big shock. Yet companies, because I would argue of the context, were like, we can't wait anymore, and we're going to proceed. So we will see if the current events, change that. But I would also point out on the earnings front, I think it's important to keep in mind that if you rewind the tape, just a little bit, basically to the second quarter of last year, S&P 500 earnings, very respectable at the headline level, 9% growth. But, you had only two sectors with positive growth, which I would argue is a relatively minimal condition for buying equities. And by the third quarter, it had become six. We're looking, for nine sectors to have positive growth. So that broadening is basically still very recent. It's only one quarter in the third quarter, and you need, a couple of quarters to sort of support hiring, is the way I think about it. So
right.
Our baseline view is that happens, both the things happen.
And finally, Binky, speaking of living in a shock-prone world, I'm not sure where this one ranks on the actually being that shocking, but the president coming out and making comments that were read by the market as allowing for continued dollar weakness, right? And so as an equity strategist, I was curious, just sort of high level, how you think about the dollar and whether the weaker dollar is good good or bad for corporate earnings overall, right? Because you're talking about earnings on the one hand, but you're also talking about demand for U.S. assets. So on balance, is it a good or a bad thing?
I'd say it's neither a good or a bad thing. Obviously, there is an impact on U.S. earnings, and a lower dollar is positive for U.S. earnings from a translation point of view. But I would say that's sort of a low quality boost to S&P 500 earnings. It doesn't give you, volumes or operating leverage or anything like that. It's just a pure translation impact. But it is positive. It's not a negative. But I would argue, if you think about the reasons for why the dollar is going down, I would say, the recent events are more sort of in the context of specific catalysts that speed up or slow down moves. I would say, the fundamental reason for why the dollar is coming down is because we lived in a world where the rest of the world was not growing. It just hadn't basically recovered from the pandemic. I would say, with policy initiatives and otherwise, the rest of the world is starting to grow. So that's why we had basically at a fundamental level the big move in the dollar last year. And our house view, which I'm fully on board with, is for the dollar down cycle to basically continue. The dollar has put in, long cycles that last 6 to 7 years on the upside and the downside. It was basically sitting at the top for 2 years as the rest of the world wasn't growing. And now the signs are that it is growing, so it's coming down. So coming back to equities, I think it's just not mechanical in terms of the dollar and what it means for U.S. earnings and therefore U.S. equities. I think you have to think about why the dollar is moving. And if the dollar is moving because of the rest of the world growth, that's obviously positive for the rest of the world equities. But it's also positive basically for U.S. equities because, we do get anywhere between 30 to 40% of S&P 500 sales coming from the rest of the world.
Gotcha. So it does have obviously some positives for this reason. Binky, thanks so much. It's always great to see you.
Yeah, it's a pleasure, Julie. Thank you for having me.
Thanks. Coming up next on Morning Brief, we'll bring you today's top trending tickers, count you down to the opening bell, and look ahead to the Fed meeting. Now time for some of today's trending tickers. We are watching chip stocks, Starbucks, and GE Vernova. First up, the chip trade. Nvidia shares are rising ahead of the open. Reports say that Beijing has given Chinese companies the green light to purchase those H200 chips. The Journal says the announcement came as Nvidia CEO Jensen Huang visits China. Some of the companies that were approved included Alibaba, ByteDance, and Tencent. And that comes amid a strong backdrop for semis today. Both ASML and SK Hynix reported strong fourth quarter results overnight, and shares both in those countries and the U.S. listed shares of ASML have been rising. Next up is Starbucks. Shares of the coffee giant soaring as sales in the U.S. rose for the first time in 2 years in the fourth quarter. U.S. and North America same-store sales were up 4% from a year ago. The company also showing better than expected sales in China. As for the broader results, it was a mixed picture. Earnings did miss expectations. Revenue beat the street. And finally, GE Vernova. That stock is under pressure despite reporting solid fourth quarter results and raised guidance. One key metric did miss expectations. That was EBITDA. The company's benefited from the AI build out as it makes equipment for electricity generation. CEO Scott Strazik saying the company's entering 2026 with significant momentum. One continued weak spot is the wind business, which has come under fire from the administration. The Federal Reserve will issue its first rate decision of the year today, but the bigger focus, of course, for investors will come during the press conference when Chair Powell will field questions on the path forward for rates, perhaps and probably his criminal investigation, and the future of the Fed's leadership. Joining us now, Brij Khurana, Wellington Management Fixed Income Portfolio Manager, to talk more about that. So, what question would you ask if you were sitting in that room today?
Oh, well, I would ask something that he's definitely not going to answer, which is he going to stay on past May? He's refused to answer that thus far. That comes up every meeting.
Well, maybe he hasn't decided yet. Maybe it's going to depend on all of these outside factors.
I think you're right. He wants to create as much optionality as possible. That being said, he has taken more steps recently to defend Fed independence. He had that Sunday statement, press conference video, and then he also was at the Lisa Cook Supreme Court hearing. So maybe this time he is going to, answer that question that everyone wants to know.
Maybe he will. And if he does, what are the implications for markets?
Well, I think that I think it's very important because as much as we're talking about who the next Fed chair is going to be, is it going to be Rick Rieder? Is it going to be, someone else? The point is that this is an institution that is trying to defend its independence, and it is still a committee with a very wide range of views. And I think what you're going to get out of the press conference and the statement is, if you look at where core inflation has moved, it's been about 2.8% for quite some time. So they might comment on the fact that inflation's progress has come down somewhat. And at the same time, the unemployment rate has been relatively stable. So, I think there's a lot of people who are pricing in a lot of cuts into the market's pricing a lot of cuts by the Fed. And those might be disappointed because, there is, as I said, even if we might have a dovish Fed chair, there's still a large views on the committee.
Okay, so maybe you can't answer this next question then, but I'm going to ask it anyway. I'm looking at the poly market odds, which seems to be the thing that we're doing now.
That's right.
Rick Rieder currently at 40%, Kevin Warsh at 32%, and everybody else is sub 10% at this point. If it's Rick Rieder, market reaction.
So I think we kind of are starting to see the market reaction when his probability was even higher a day or two ago. I almost see the exact opposite reaction between a Kevin Warsh and a Rick Rieder. So it really depends what the administration is looking for. Are you looking for lower short-term rates or you want lower long-term rates? Lower short-term rates, I think, go with Rick Rieder because he's spoken about how he believes we're in this AI productivity boom, this disinflationary growth, which does not need the policy rate to be high because that's slowing the residential investment sector. So
he's also said he thinks those rates need to be lower to help the housing market.
Correct, exactly.
Specifically.
That's right. Yeah. And, I think because he's a market participant, will be much more using the balance sheet of the Fed to resolve any kind of financial issues. Kevin Warsh is more hawkish, certainly on the balance sheet side of things. So I think, but what's interesting is we have a lot of term premia in the bond market, meaning that as you extend maturities, yields are a lot higher. And I think that's because there's so much uncertainty over who the next Fed chair is going to be and what policy is going to be in the long term. And so I actually think, ironically, if you do get a Kevin Warsh, even if he's more hawkish, you could actually see back-end yields come down compared to a Rick Rieder, who I think back-end yields probably rise, but short-term rates fall.
Okay, so you did answer that question.
Yeah, I did,
I appreciate it. Okay, so there's all of this going on, and then there's stuff that has nothing to do with the Fed, but much less to do with the Fed that are affecting the bond market. There's what's going on with the dollar. There's what's going on in Japan as well, which is having sort of ripple effects. And so even if the Fed, under whomever, starts to cut more, does that mean that we might not see the longer end of the curve come down?
Well, it is a good point. I mean, since the Fed started their cutting cycle now a year and a half ago, long end rates are higher than they were when they started cutting. And so there is certainly that disconnect. I do think the news that's been coming out of Japan and the Japanese yen is important for bond markets, but maybe in ways that people aren't anticipating. So if you listen to Scott Bessent last week, he talked about the fact that why are U.S. yields rising? It has more about global factors, particularly the fact that Japanese bond yields have risen so much. So he wasn't blaming it on the conversations about Greenland. He thought it was really about Japanese bonds. And so I think this is an attempt by the administration to kind of decrease the volatility on the yen and try to repatriate some capital back in from Japanese investors back into their own bond market. And the view there is if you stabilize Japanese bonds, then you can also stabilize US bonds. So it's an interesting.
But if you're repatriating from the US to Japan, that implies continued pressure on bond prices here in the U.S. and yields going higher.
So it's a bet. It's a bet that I think they're willing to make because.
You mean that washes out and then stops?
Right. So if you look at Japanese bond yields, they've risen, close to 100, 150 basis points at the back end of the curve. And so their view is I think this is their view, that if you stabilize those yields and even if you bring them down, even if you have less flow into U.S. fixed income, at the same time, the global factor should reduce rates even more at the back end. That's how I think that's how they're trying to do it.
Is that going to work?
So I do think that one of the reasons back end yields are so high, it's not just a US phenomenon, it's not just because, inflation expectations are still very low as priced by the bond market. So this idea of high term premia takes place in the US, you see it in Australia bonds, you see it in United Kingdom bonds. It's really everywhere you have very steep yield curves right now. And so I do think it's more of a global phenomena and really being led by Japan.
Interesting.
Yeah.
So you expect then yields to come down along with benchmark interest rate cuts in the US?
I think that there's a lot of value at the back end of the US bond curve and other bond markets. If we look at forward rates, which adjust for the steepness of yield curves, which is really how you have to look at things, 10 years treasuries 10 years in the future are close to almost 5.5%, which is very high. It's hard to envision nominal growth staying at this elevated level, given we've had so much fiscal, we've had so much consumption. It's hard to imagine that continues for a lot longer. And so I do think there's a lot of value in the back end of curves globally.
All right, see what happens.
Yeah.
Thanks, Brij. Appreciate it.
Appreciate it.
Coming up on Yahoo Finance Opening Bid, our executive editor, Brian Sozzi, is joining us. You're going to take a deep dive into the Japanese bond market on the show today, right?
Definitely not, Julie. No go. And, while I'm excited about everything you just said, excited about the big Starbucks quarter, excited that it's Fed Day, I'm pushing that aside because I am more excited. Big guest coming right onto the show, Julie. You know him. I know him. It is Yahoo CEO Jim Lanzone. Big moment for Yahoo and its long history here, and I am psyched to bring Jim on. Ready to go.
All right, I'm excited to watch it. Thanks so much, Saz. That does it for Morning Brief. We got much more ahead on Yahoo Finance, including Opening Bid.